In the previous lesson, we had a detailed introduction to the financial statements of a company and what items get reflected where in the financial statements. Now, let us take a step further and learn how to analyze the financial statements that are prepared. First and foremost, let us understand the meaning of analysis of financial statements. Before looking into the technical meaning, I'll give you a small example. Now, all of you know to read English, right? How? You studied with the ABC, and then the words, and then sentences, and finally paragraphs, and now you can read books. So, English is a language that you know to read, correct? Similarly, now we will learn how to read the financial statements. The financial statements have almost all the information relating to a company. You just need to know the right method to read the financial statements in order to know what the financial statements want to convey to you regarding the company. This is the simplest meaning of analysis of financial statements. So, the analysis of financial statements means the process of reviewing and analyzing the facts that are reflected in the financial statements. This is done by presenting the information in the financial statements as distinct components or in a distinct or a more meaningful way with the help of certain scientific methods. Presenting the required information in a scientific way helps the company to make informed and rational decisions in order to improve the operations of the company. The financial information available in the financial statements is evaluated in order to bring out meaningful comparisons and conclusions. The analysis of financial statements helps a company to make both financial as well as non financial decisions. Let us understand how the analysis of financial statements is of use to various stakeholders of the company. Here, we can see that the analysis made out of financial statements is helpful to the stakeholders who have different objectives to achieve from this information. Let us discuss this one by one. In respect of the use to finance manager, they are internal stakeholders who handle key responsibilities in respect of various financial decisions within the company. The financial analysis equips them to take rational decisions in areas like corporate efficiency, managerial performance, assessing financial strengths and weaknesses, and creditworthiness of a company, as well as to analyze various deviations. It equips the finance manager in studying the accounting data to determine whether to continue or alter any existing policies. It also helps to have a good grip on the financial controls and make constant reviews in the financial operations and understand the reasons for deviations if there are any. In respect of the top management, they are the internal stakeholders that are most concerned with the survival and long term vision of the company. So, it is fair to say that the top management has the critical use of the conclusions drawn from the analysis of financial statements. Financial analysis helps to measure the success or failure of operations of the entity as well as individual departments, and also helps in evaluation of process of internal control. The top management has the overall responsibility to see that all the overall resources available with the company are utilized to the most efficient detail possible, and the analysis of financial statements helps them to understand which areas are working efficiently and which are the areas where there is scope for more improvement. In respect of trade payables or creditors, these are the parties against whom the company has short term liabilities. The analysis of financial statements helps the creditors to know the company's ability to meet the financial obligations in current as well as future scenario, and also to evaluate the liquidity position of the company. With the help of financial statements, they can realistically judge by when the company will discharge the liabilities that are due to them. In respect of lenders, these are the parties in respect of whom company has long term liabilities. The financial analysis helps to evaluate the long term solvency and survival probabilities of the company, as well as its ability to generate enough income to pay off debts, including interest and principal portion, since the lenders are keen to know the long term faring of the business of the company. In respect of the investors, these are the parties that will invest their money in the company's shares. They are interested in understanding whether their investment in the company will grow and reap returns for them. The financial analysis helps them in evaluating the company's earnings and analysis of current and future profitabilities. It also helps in studying the company's capital structure to ascertain any positive or negative influences on the company's earnings. In respect of other stakeholders like labor unions, government, as well as economists and researchers, the financial analysis helps them to further evaluate the existing business and economic conditions of the company in order to study in depth the areas which they are concerned with. So, these are the significant uses of analysis of financial statements to the various stakeholders. Now, let us see what are the objectives to be achieved for which the analysis of financial statements is done. Firstly, the analysis of financial statements is done to identify the reason why the profitability position of a company has changed between years or between quarters within a year as well. This helps the company to take corrective actions if any are required. The analysis of financial statements helps to assess the profitability, operating efficiency, and the earning capacity of the organization as well as its departments. So, each department can be analyzed in order to understand if any additional resources are required towards any department or if any resources are in excess and hence unutilized. The financial analysis helps to ascertain the relative importance of the various components and its bearing on the current and future financial position of the company. This means each item can be judged in relation to certain other items in the financial statements so as to ascertain what will be the impact of such conclusion on the financial position of the company. As we discuss the financial analysis in more detail, you will understand the importance of this point. The analysis of financial statements helps to facilitate comparisons between the various departments of a company as well as comparisons between two or more business entities. It also enables to conduct comparison between two different points of time. This helps to have meaningful comparisons between departments to ascertain which department is more efficient, and also between two periods of time to ascertain how the company has fared in two different points of time and what are the factors that have led to either a better or a poorer performance. Also, the analysis of financial statements helps to assess the short term and long term solvency position and repayment capacity of a business entity. This helps an organization to take informed decisions while making borrowings and while taking decisions regarding expanding the business of the company. Now that we saw the objectives with which an analysis of financial statements is done, now let us discuss the limitations of the analysis of financial statements. Firstly, financial statements reflect the monetary performance of an organization. Accordingly, the analysis can also be made for the monetary portion of an organization's performance for a given period of time, whereas the non monetary aspects are left out. The transactions in the financial statements are recorded at a historical cost. When the financial statements are ready and presented to the stakeholders, the amounts are at a grossly historical value and are not reflected at their current values. Further, it also does not consider the price level changes and market changes. So, the information present in the financial statements is not current. Therefore, the analysis may not hold completely appropriate conclusions, especially where the organization operates in a highly dynamic environment. Also, the financial statements are prepared on the basis of accounting concepts and again thereby do not reflect the current position of the business. Further, since human element is involved in the preparation of financial statements, there could be a possibility of fraud, etc., when the statements are prepared. This may or may not be highlighted in the financial analysis. There is a possibility that certain changes adopted in the accounting procedure may not be intimated in the financial statements. As such, comparisons or conclusions drawn on the basis of the previous accounting procedure may be rendered misleading or meaningless. Also, the financial analysis means the analysis of an existing financial statement. It is a study of an existing report without any predictive futuristic value. So, these are the limitations of analysis of financial statements. Now that we saw all the theory concepts, in the next video, let us discuss the tools and techniques of analysis of financial statements.